Picture this. You open your 401k statement and your stomach drops. The market had a rough month, and the number staring back at you is thousands of dollars lower than it was 90 days ago. If you're 5 or 10 years from retirement or already retired, that feeling isn't just uncomfortable, it's terrifying. Because unlike when you were 35, you don't have decades to wait it out. Here's the question I get asked more than almost any other. What actually happens to my money inside a fixed index annuity when the market crashes? By the end of this video, you're going to know exactly how that works. The floor that protects your principal, the reset that sets up your recovery, and why this tool behaves completely differently than your 401k or brokerage account during a downturn. Let's get into it. Before we talk about crashes, let's make sure we're on the same page about what a fixed index annuity or FIA actually is, especially if you're new to this channel. When you put money into an FIA, that money is not invested directly in the stock market. You don't own shares. You don't own a mutual fund. Your money sits inside the insurance company's general account. What happens instead is this. The insurance company credits interest to your account based on the performance of a market index, something like the S&P 500. If that index goes up, you can be credited a portion of that gain, up to a cap or based on a participation rate. If that index goes down, here's the part that changes everything. You don't lose money because of it. That one distinction, not being directly invested, is the entire reason a market crash plays out so differently inside an FIA than it does inside a traditional investment account. Let's walk through exactly what that looks like. Let's use a simple round number so the math is easy to follow. Let's say you have $100,000 in a fixed index annuity. Now let's say the index it's tied to has a rough year. It drops 20%. In a regular brokerage account or 401k invested in that same index, your $100,000 would become $80,000. That's a $20,000 loss on paper in a single year. Inside the FIA, here's what happens instead. Because the contract has what's called a floor, typically a 0% floor, your account is credited 0 for that year. Not negative 20%, 0. Your $100,000 is still $100,000, assuming there were no withdrawals or fees pulling from that balance during the year. This is where you'll hear people in the annuity world use the phrase, "zero is your hero." It sounds simple, almost too simple, but it's the core mechanic that makes an FIA behave so differently in a downturn. The index can drop 20%, 30%, even more in a severe crash, and your credited interest for that year simply doesn't go below 0. You didn't gain anything that year, but you didn't lose anything either. And when you're a handful of years from retirement, not losing anything in a bad year can matter more than people realize. That takes us to the next piece, because what happens the following year is just as important as what happened during the crash. Most FIAs work on what's called an annual reset, sometimes called an annual point-to-point. At the end of each contract year, the index value is essentially reset, and the next year's growth is measured from wherever your account stands at that moment, not from some earlier high point. Here's why that matters so much after a crash. Go back to our example. Your account was at $100,000 before the crash. The index dropped 20%, but you were credited 0, so you're still at $100,000. Now imagine the index bounces back strongly the next year, up 15% for example. Inside the FIA, your growth for that recovery year is calculated starting from your full $100,000. You're not climbing out of a hole. You're simply moving forward from where you already stood. Now compare that to the brokerage account. The account dropped to $80,000 in the crash. When the index goes up 15% the following year, that 15% is being applied to $80,000, not $100,000. The account needs a stronger recovery just to get back to even before it can start making real forward progress. This is the compounding difference that most people never see until it's illustrated side by side. The FIA didn't outperform the market that recovery year. It simply never had to dig itself out of the hole in the first place. Over several years, that gap between recovering and growing can become significant, especially during the specific years right around retirement when you can least afford a setback. Now, I want to pump the brakes here for a moment because I never want you to walk away from one of my videos thinking a financial product is magic. It isn't. And I owe you a balanced picture, not just a highlight reel. Fixed index annuities are not free trade-offs. A few things you need to understand. There are simply surrender charges if you withdraw more than the allowed amount in the early years of the contract. This is not a liquid walk away anytime account, and it isn't meant to be. Your upside in good years is limited by caps, participation rates, or spreads, depending on how the contract is structured. If the index has a phenomenal year, up 25 or 30%, you're not going to be credited the full amount. The insurance company is taking on your downside risk, and in exchange, they limit how much of the upside you receive. And to be direct with you, an FIA is not designed to outperform the stock market during strong bull years. That's not its job. Its job is to protect you from the downside, not to chase the highest possible return. Think of it as a trade. You're giving up some amount of upside potential in exchange for a guarantee that you won't lose principal because of a market drop. Whether that trade makes sense depends entirely on your situation, your timeline, and what role this money plays in your broader retirement income plan. So, who is this actually a good fit for? If you're still decades from retirement and your goal is aggressive growth, an FIA is probably not the primary tool for that portion of your portfolio. This isn't a growth chasing strategy. But if you're within 5 to 10 years of retirement, or you're already retired, the conversation changes. At this stage, protecting what you've built often matters more than squeezing out the last few percentage points of return. This is especially true because of something called sequence of returns risk. The danger of experiencing a major market drop in the specific years right before or right after you retire, when you're also relying on that money for income. I've covered that topic in more detail in another video, and I'd encourage you to check it out if you haven't already. For a lot of my clients, an FIA isn't their entire retirement plan. It's one piece, the piece that's specifically designed to hold steady when the market doesn't. Let's bring this together. Inside a fixed indexed annuity, your principal is shielded from losses caused by market index drops, thanks to that 0% floor. Your growth resets each year from wherever your account currently stands, which means recovery isn't a race back to even. It's simply moving forward. And in exchange for that protection, you accept some limits on your upside during strong market years. If you want to learn more, check out the free booklet called Retire Smart. It's linked in the page in the description box. And if you found this helpful, subscribe to the channel because we cover exactly these kinds of retirement decisions every week. I'm Shonda Prescott, and this is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.